Tom Lee might end up right on the money with a $7,000 price target on the S&P 500 for 2025. However, his crypto call, well, that's a totally different story. Maybe he would have had better luck with silver. As for the S&P 500, though, the stat bros will attribute the strength to the Santa Claus rally seasonality and likely start talking about as goes January, so goes the year. But in my view, all you really need is the technical chart, not thousands of different quant studies. Simply put, the markets are right on the verge of a multi-month breakout. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, last week, of course, a shortened holiday trading week, solid green-bodied bar, just a little bit of a lower wick, and once again, a fairly compressed range in terms of the net distance traveled, very similar to the weeks following the Thanksgiving shortened holiday trading week. So all things considered, structure does strike me as being bullish, with a strong close from the buyers at the highs of the weekly range. If we're thinking about location on the bar-to-bar count, of course, a higher low as well as a higher high, and a candle close completely outside of and above the previous week's range. Now, in the intro, I mentioned that we were dealing with a multi-month breakout that's really breaking out of this weekly equilibrium here with a brand new all-time high close. So in terms of structure and location, it strikes me as being bullish alongside with the overall trend count of the weekly time frame. This is a new higher high. So generally speaking, the trend remains in the upward direction. Of course, there's going to be no change to our reference points if we come in with the fibs from here to here, of course, above the 38.2, well above the 38.2 from here to here. We're basically sitting at the top end of the fib retracement pole. If we come in with the anchored view apps, no doubt above the entirety of the stack. There's really nothing bearish to say here on the weekly time scale. Of course, the new closing high as well will put us up and over the weekly volume profile, but let's just zoom out so we can double check on this in here. If we were to pull back, we can play this game a little bit more firmly. If we were to pull back, then ideally we wouldn't really take out the previous week's low, right? If we just zoom back in to this weekly time scale, it would be this low right in here. As long as we could stay above the low from the Wednesday of now 2 weeks ago, that would produce the possibility of weekly trend compression, really, with the opportunity for something like this to become the emergent pattern, right? If you really want to use the high of that wick, then technically speaking, we haven't really broken out with momentum, but it is a brand new weekly closing high. So on the weekly chart, things look really good. I also want to point out for today's episode the SPXT, and that is going to be the S&P 500 index without the influence of technology, right? So if you strip out the XLK, the technology sector, you can even see over here that this market looks pretty darn good. Now, I know we're not talking about breadth yet, but from the weekly timescale, I did just want to point out, it's not like NVIDIA, the one stock to rule them all, is the only thing pushing this market back up towards the highs. It's a broadening out of the market rally, which does strike me as being fairly constructive. Let's get on down to the daily timescales here and see what's going on from this perspective. First up, let's evaluate this week's expected move. If you're not familiar with the expected move, it's this gray box right here. You can check out the video tutorial in the top right-hand corner on how to set this up. If we're contained by the upper bound, the number is at 696.89. That, of course, implies a brand new all-time high. And if we're contained by the lower bound, the number is 683.73, implying a higher low relative to that Wednesday low we were just looking at on the weekly timescale as a lower wick. So all things considered, expected move does strike me as being bullish, noting the higher high and the higher low. Once again, you can see on the Friday session, although it was incredibly light volume, to be expected, right? It was the day after Christmas. It's sitting right beautifully right above these prior highs. The daily structure here is really constructive. So in the trend count, right, this is inherently a brand new higher high. And if the hourly trend were to flip to down, we'll take a look at that in just a second. There's plenty of room to continue this daily trend via lows. This is now a firm higher low via the hourly downtrend that happened in here. If we were to flip into an hourly downtrend, I think it would be quite obvious with the opportunity for a Brigade bolt to the downside underneath the previous highs. You could start thinking of this through the lens of a failed breakout first, but once again, you're just seeking a daily higher low on the pullback. Now, in terms of pullback location, we talked about this from a weekly perspective. However, on the daily chart, it would be quite clear that any higher low would ideally come in here, close the gap perhaps, and then attempt a move in the upward direction. So, is that confluence with anything reasonable? The answer in my view is absolutely. The orange moving average on the screen is the daily 20 SMA. That's the top of the gap as of right now, and the lower edge of the weekly expected move. That would be close to about 680 to 80. If the gap closes all the way, that would be 681 31.15. And if we look left, the main thing I want to continue reminding us about is that if we go gap fill reversal, so let's say the market comes in and does this, it's not only a higher low, but it's not even a retest of the top end of the bear engulfer bar from the 1120 session, as well as the 1010 from way back over here. Remember that golden pocket zone around 675. So the higher low is not another retest of that same exact level, which gives us a little bit more breathing room to persist in this daily trend count. So all things considered, the chart does look healthy and bullish here. There's some pretty thin structure rallies that took place through the Christmas holiday week, of course. So if there's some give back, it would not be all that unreasonable to come in and attempt some kind of higher low. Again, that's the main narrative here on the daily time scale. Higher lows are certainly going to keep the trend up, and clearly just continuation in the upward direction will as well. The picture perfect situation would just be bullish consolidation here over the 689, getting follow through over the all-time high and targeting the 2 times the bear engulfer bar. Remember, if you were to double this range and stack it right on top, I know it looks kind of funky, but that's technically the target in there around 695. A doubling of that engulfer. You could take the same approach from this perspective here. If you double that engulfer in the upward direction, it would actually overshoot that by just a hair up towards that 695. So that's one possible target. The other possible target is really using the weekly equilibrium as a doubling, right? So if we were to just come in here, I'll quickly use a fib tool to do this. Let's come from the low to the high, and we'll just stack, double that range to the top side. I mean, not that I'm saying we're going to 725, 726 in the coming weeks worth of trade, but if this is a weekly equilibrium breakout, as mentioned in the intro, if this is going to be the start of a new leg higher into the new year, maybe that's a forecast target. We'll take it day by day, as we always do, day by day, week by week, but just a number to have in the back pocket. Close to that 725, 726 would be the measured move from the range double that we're evaluating from a weekly perspective. So with that, let's take a look on down at the hourly time scale to see, is it likely that the hourly trend flips to down in the near-term future? Well, Friday is really difficult to actually read into just because there was such a lack of volume, and I don't think you had anyone really committing anything on the new all-time high. So in my view, yes, we did repair the overnight all-time high that was left unrepaired from way off to our left. However, the daily structure as that indecisive doji doesn't really tell us a whole lot about the commitment of buyers or sellers. If anything, once again, indecisive doji literally just points to a question mark. We need more information to determine whether or not this is going to be constructive for the trend. So back to the hourly chart, if this is going to start looking a little bit like a head and shoulders, you could go intraday lower high here, that's fine. But once again, I would only start looking for a reasonable retracement short on some kind of Brigade bolt lower high underneath 689. If you don't get that, if there's no movement under 689, if the market's just here, I would think through the lens of bullish consolidation, call it an hourly bull flag, and possibly seeking continuation over the span of time. Once again, if the market's going to pull back, look left, thin structure retracement. First target would have to be the Monday high, coming back for a retest there, and then we could start thinking about this gap range that we were describing on the daily timescale with confluence to the lower edge of the weekly expected move, daily 20 SMA, as well as a retest to the top end of the Wednesday session, which kind of threw a big wrench in the mix of the main thesis on the first attempt at the moving average stack. So once again, daily higher lows in this zone. You're only looking to get there if you produce a lower high under 689. Consolidation over 689. Brigade bolts up and over the all-time high into the 2 times engulfer target, 695, and then the upper edge of the weekly expected move there at 696.89. If we go ahead and take out a Fibonacci from the bottom of this move, the closing low up to the high, you can see that the Fib 38.2, 50%, 61.8, basically no man's land is what we call it, but generally no man's land is supportive, right? That is right in the zone of that gap fill reversal for the daily higher low. So just reinforcing that as a bit of an interesting point, or an inflection point, we should just say. If we come in from the gap up low of the Monday session up to the high of last week, the Fib 38.2 is a slight overshoot of the previous all-time high from back over here and even further off to the left. So if we were to hold this as bull flag consolidation, it would be exactly that. And once again, it's one of the reasons why I don't really think it's even worth thinking about shorts until you're under 689, breaking that Fib 38.2, allowing a little bit more of that thin structure retracement as we've just mentioned. Let's check in with the anchored VWAPs intraday just to get a sense of how this is playing out. Well above the anchored VWAP from the Monday gap up. If this starts to, let's say the market goes sideways for a session, builds out consolidation, anything that's supportive here, that might act as the quote, not guaranteed, but maybe sort of like a quote launch pad for the next potential move. If you get confluence there, the market supports it one final time and then makes the push, I could easily see that, right, as a bullish continuation of the overall trend count that we are trying to navigate through. Bunch of gray anchored VWAPs in here from minor reference points. The big white anchored view app is the low of the 1120 bearish engulfer, and you could see that this is generally a cluster in that golden zone for the next ideal daily high or low. If the market pulls back into this area, I would not take a short stance on the market. I would be seeking, okay, is there any kind of reversal here? Is there any remount over the daily 20 SMA where we can get involved on a look below and fail again over that 682.80, the daily 20 SMA at the anchored view app stack? As we know, the fib 68.1 when we pulled it from point A down here up to point B, the brand new all-time high. So that's really what I'm looking for this upcoming week, either a gentle pullback under the 689 as we head into the new year, or just bull flag consolidation and continuation into blue sky territories as we move through the week. It's another shortened holiday trading week with, of course, the market closed for the full session on January 1st. There is no half day prior and there is no half day the day after, but do expect just generally light volumes until we go for the first full week of January, which is, of course, not this upcoming, but the week after that. Let's check in on the good old market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? Again, with respect to it being a shortened holiday trading week, really not all that bad. Volume flows were technically into the market. I would say that primarily on the gap up Monday, you can attribute a lot of the strength to that. If you look at the advanced decline line, it's not like it was in trend higher zone, but it certainly was positive. I like the rebound happening here on Wednesday as we rallied before the half-day cutoff. The market did have a nice grind in the upward direction. And then on Friday, once again, really sideways there. If we're going to read into anything, it might just be the fact that the market rallied quite a bit on the shortened holiday trading week through thin volume. It wouldn't be unreasonable, noting that Friday started to go sideways on a mixed bag of internals. Notice that this really isn't all that strong here, not really all that strong here. The index score is basically a big old goose egg through the entirety of the session, and the cumulative build down here didn't go anywhere. Negative 1,000 is not anything to shake a stick at. You want plus or minus 5,000 to start saying, oh wow, that's substantial, right? So is the market slowing down after a very impressive advance through the shortened holiday trading week? I think so. And once again, it wouldn't be unreasonable for a pullback to come through and sort of take out some of this thin structure that we've just been talking about. But once again, the only time that I would actually execute on that idea is if we're under 689 from a levels perspective, right? If this starts looking like a look above and fail from the daily chart, right, through these prior highs, look above and fail, okay, maybe we get a retracement, but still looking for that higher low zone right in here, as we've talked about in quite a bit of detail through today's episode so far. Let's check in with the market profile. How's the ES look from this perspective? If you're not familiar with profile, check out video tutorials in the top right-hand corner. What do we have here? Value continued to march in the upward direction. You could see here, and then on Friday, just inside of that Wednesday session, remembering markets were closed, of course, on Thursday. So you got a decent excess high in A period, but value didn't really do anything. It's not like it broke away clean to the downside and sellers are really flexing the muscle and saying, hey, look at us. We're going to, this is it. It's game over, right? If we were going to get that, value should have moved lower on Friday. It just didn't. I think it's very clear, right, that if you were to take out Friday's low, you're also dropping the value area low from the, not Thursday, but rather Wednesday session. And therefore, right, it makes sense to me that losing that 689 on the Spider's cash would be roughly the equivalent of this zone here on the futures. If you drop that, right, that's really where you're talking about that pullback developing. Is anyone really shocked about this? Shouldn't be. It's 689. Just reinforcing that from a market profile perspective here. We have decent excess on the highs and lows on all sessions, maybe a little bit of a 45-degree line here on Friday. Typically, that's a bit of a bad sign for shorts, painting themselves into a corner, but for now, again, very light volume. Value is unchanged from the Wednesday session. Just take it day by day. If you take Friday's low out, maybe a bit of a pullback, but once again, Monday's high is the place we're looking to pull back into. First place for a higher low, and then the gap fill zone down below, as again, we've described in excruciating detail in today's analysis thus far. Let's jump on into the QQQ NASDAQ side of things. When I bump this to a weekly, we're going to lose volume down below, but that's fine. Let's get on into the clean drawing set here and see what we have in terms of the weekly bar. So structure is a little bit more muted, right? It's definitely hammer-esque in nature where that lower wick suggests buying pressure in the whole 9 yards. It's a green-bodied bar. So we closed over the opening print, of course, but it's not like we had range expansion in any particular direction. We did not get a breakout here in the QQQ like we did in the S&P 500. If you do this, we're still just kind of in range compression from that perspective. We also haven't really taken out this lower high in here. So that's the next major hurdle on the weekly time scale. If bulls are really going to step up and get the job done here, I would need to see something that starts looking like this to just, firstly even get to the all-time high, never mind through it. So this pivot in there is a primary place to be thinking about. That's 630 roughly. The structure and location, again, we didn't talk about location bar to bar, but it is nonetheless a higher low as well as a higher high close outside of and above previous week's range. It still looks good. It has a lot of the similar characteristics to the S&P 500, but it just didn't quite break out to blue sky territories like the S&P did. Let's jump in with the fibs. Again, a lot of this stuff is going to be kind of the same as it's been the last couple of weeks over the Fib 38.2 from this perspective. From this perspective, that's a no-brainer as well. If we clear both of those up and come in with the anchored VWAPs on the weekly, above the entirety of the stack, little resting bar basically right above, and that does strike me as being more bullish than bearish. We can come in with the volume profile as well, just to be completely congruent in the analysis. We'll come in with a couple of high volume nodes. We closed right at this high volume node, but clearly over the main high volume node, which was used as support in the Wednesday low of now 2 weeks ago. Let's drop it on down back to the daily charts, and let's go on over to the QQQ weekly expected move. What do we see here? It's a little easier. I don't have to reconfigure the screen because it's on the screen. It's not, poking out into blue sky territories. The upper edge is 631.90. If we're contained, that is technically speaking a higher high relative to the pivot high from back here. Very nuanced, but it is. And if we come into here, that is also a higher low, the lower edge being at 615.88. So the expected move strikes me as being constructive and bullish for the market. I would think that any pullbacks ideally stay over this area right here, the daily 20 SMA. That's 618.50. Why is that such a big battleground? Because if we think about this range back here, that is ideally where sellers would have yielded a lower high if the market was going to be under more pressure, potentially reversing into the first half of 26. Now, of course, that's still a possibility. You could ultimately just yield some kind of double top in here, and we'll talk about that when and if it does start to develop that way. But for now, the trend count is such that it's neutral. We have lows. This is technically speaking a higher low now that we've recovered not only just over the 613, but once again into the overhead supply from here. We've retaken that 618.50, which is why it's a key higher low going forward from here, but also we have to respect the top side, right? From here to here, there's undoubtedly a more meaningful lower high versus the S&P 500, and it's still possible, right? Because we don't have that confirmation yet, still possible you could be getting a lower high here as well. So the base case is still that we're trying to work ourselves into an uptrend. The S&P is trying to lead the market higher. We know that it's a bit more broad and diversified in the S&P 500 versus the NASDAQ 100. We saw that with the SPXT, on the weekly time scale. If you were to look at the QQQE, right, let's just actually do it. Why not? I know we typically save breath for much later on, but the QQQE, I would say, is more similar to the S&P 500 rather than the QQQ weighted, which clearly has a much more meaningful, lower high. I'd say this is more so on par rather than if we just go back to the QQQ, right? You could see how this is a little bit deeper, a little bit more in terms of the divergence that's ultimately there. So what's the next major weekly pattern? I'd say it's to break that trend line we were just describing. And then what does that do for the market ultimately? This is a low. This is a higher low. This ultimately ends up looking like a double bottom, higher low after the neckline break. Let's see if we can get back to the all-time high. So that's what the constructive buyers want to see into this upcoming week. And of course, higher lows over the daily 20 keep us inside of the previous overhead supply. I would say it's easier to drift into a more neutral stance here on the NASDAQ versus the S&P 500. If we fail that daily 20 and we just get tangled up at the 50 SMA between a rock and a hard place, here's your hard place above, here's your rock, which has really acted as an anchor underneath us. If we're between 618.50 and 613, I really don't think that's a great spot to be in the market. Now, I will still maintain a stance that this is a bullish higher low and this is a bullish higher low, and I would maintain this stance so long as the S&P 500 is also still in a constructive uptrend. If the S&P just immediately flushes and goes down to make some sort of equal low, and the NASDAQ for some reason has some strength and is still trying to offer a higher low here, might be a little bit more skeptical about that, rightfully so. But for now, as long as the S&P 500 is continuing to stage its breakout of the multi-week balance, I would remain constructive on a NASDAQ pullback over 613. And this will be the equivalent, basically, of the thin structure retracement, right? You got a little bit more of that into the Friday session of now 2 weeks ago versus what we had in the S&P. If we just go on over to the NASDAQ here, you could see, right, there's not only thin structure through this break, but you also haven't come in through any of that on the NASDAQ here. So here's the hourly chart, right? If the trend is going to flip to down, you need to produce some sort of topping pattern. And once again, like the S&P 500, I would use this level as my over-under. That's going to be at 623. It's Friday's low. If you're consolidating over Friday's low inside the range there, then great. Bull flag consolidation maybe leads to the equal high. That would be really constructive from a daily perspective. If we just sort of notch it back for a second, though, and think about the hourly, if we do this and then this, right, the daily trend isn't over. It's still just compressing. This would be the first place to battle for a potential higher low. And, use your S&P 500 as a proxy or a gauge to help understand, should you be really looking at this aggressively, or maybe take a back, little bit of a back pocket approach to that. And I would say it would be similar to the way we took a back pocket approach and gave the NASDAQ a little bit more of an overshoot opportunity. What do we know about the NASDAQ, right? We say it every single morning at 8 o'clock in the pre-market prep. It's the Wild West of the market. We call it the nasty NASDAQ for a reason, because it overshoots. So if you overshoot in the Qs on this particular move in here, that is okay as the S&P 500 still maintains some semblance of a higher low. And it would also be okay, and I would probably start to say my line in the sand would just be 613. You really don't want to overshoot 613 again, but you can overshoot the 618.50. So how do you actually navigate that, right? Well, to get there, you need the lower high underneath if you're going to think about taking a short from A to B. At point B, I would start to button up the short and I would start putting my thinking cap on, looking for the higher low. If you get something that looks like this, that's your overshoot situation. I'd be really hard pressed for new shorts into the daily 50. I would be absolutely against new shorts into the 613. Like, this is not a new short location. This is not a new short location. The time to get short is either at point A, because this is a look above and fail on this previous level, this and this from the consolidation back here, or maybe on a failure of the daily 20, maybe you could get short at B, targeting C or D, but I would not, absolutely not be short at point C or point D. The idea here would be if the market makes it to that point, let's just draw the overshoot clean, that's ideally where you start looking for longs, right? Be it some sort of reversal pattern here, and then you would just get bullish again. If you're skeptical of this, if you want to see the higher low, see it before you believe it, right? You see it here, you believe it there, over 618.50, right? Where does this bull thesis really go out the window? Well, if the market does this, and we're consolidating here, okay, hang on a second, head scratcher. You're not really in a compression of trend anymore. You're just drifting more firmly into a developing downtrend at that point with the daily threat of a lower high or some sort of equal low down at this 601.65. Right, so that's what I see here on the NASDAQ. We can come in with a couple of Fibonacci's just to be congruent from the low up to the high. You'll notice that the Fib 38.2 is right between the rock and the hard place, so I wouldn't read into that too much. And we can come in from, let's really take it from the Friday breakout, not the Monday gap up. The Friday breakout up into the high from Friday of now this week. This is the Friday breakout from now 2 weeks ago. Then 61.8 is roughly in this overshoot zone. So once again, if the market comes in and it does a little dance around here, if it's not clean at 618.50, but it's still respecting the Fib, then no problem, right? That is A-okay. This is still on the docket as being a potential higher low. All right, so that is really the way I'm looking through the lens of the NASDAQ, and it's tough to take an aggressive stance here. Let me just go back to the daily chart as a reminder. There's really no reason, there's no need to take an aggressive stance on the NASDAQ side of the market until you break one of these trend lines. Does it seem like we are, certainly we closed closer to the upper portion? The S&P 500 is suggesting, okay, a little bit more bullish strength, right? So it seems more reasonable that it might be worth talking about upside first, but once again, you have to actually see it to believe it. So let this bull flag consolidate, get over Friday's high, then you're at the top of the range. If you tell me, I'm waiting for a short here, I wouldn't call you crazy, right? Then you get a pullback. That's also a possibility. The market goes higher first, tests this area of previous supply, rejects, pulls in, and then gives you something that looks like this. I would still be seeking the higher low, somewhere in the, between a rock and hard place zone. But the market seems to me a little bit more bullish than bearish. And we'll see this through the supporting evidence as well, moving through today's episode. I suppose we'll go back down to the hourly, throw on the anchored VWAPs. There we go. And just point out that you get a little confluence here. And again, this cluster is going to be in the middle of nowhere. It's between a rock and a hard place. So as and if they drift higher, overshoot, is reasonable at this area, and I would maintain the bull thesis so long as 613 has not been violated in a substantial way. Let's get on over to the NASDAQ side of the market internals, see what's happening from this perspective, and we'll just primarily look at Friday, right? Friday is the day where the market balanced a little bit more, so you get a little bit more of bearish edge here on the NASDAQ side of the market rather than the S&P 500. It's something to read into maybe slightly. Maybe the market does end up pulling back just a little bit, but once again, the primary idea is to seek a higher low, and we'll see this through the supporting evidence as well. Let's jump on over to the profile of the NASDAQ side, and we'll just set this up as follows. There we go. So we can see the week's worth of trade. What's going on with value is primarily what we care about. There we go. Getting my drawing tool. Hit the wrong keyboard shortcut. Value continued to drift in the upward direction. I realize this is Friday. And then you have this and this. Similar to the S&P, excess on A. A little bit better of an excess low on B period. Unchanged value on Friday, primarily going sideways here. It didn't really build out in a substantial way, such that it suggests bears are really stepping up on that light volume session. It would just, to me, right, if you do this, very easy limiter of price. Either you have the 2-day highs that are holding and you're over the value from Monday, Tuesday, or, right, you drop that, you're under the value from Thursday or Wednesday, Friday, and you're starting to rotate back down towards these lows step by step, then looking for the higher low on the daily time scale. So very, very simple way to view this chart. Just an over and under, If you split the week in half, exactly like that, value does align with what we're seeing from that point of view. Let's get back on over to the platform here. Let's go on over to the Russell 2000, see what's going on with our small caps. Let's go up to a weekly time scale. Again, the volume will kick out on the weekly, but that is A-okay. Testing out a new study here, or just trying to use it a bit more. It's always been there, but I'm just trying to use it more. If you're interested in this, you can let me know down below in the comments section. Maybe we'll publish it on the site. As of right now, it is available to the Squawk members. But for now, weekly bar of the IWM. You've certainly got, and I'm pointing at it as it's broken literally on the weekly. Probably have to make the improvement to fix it on the weekly, and then also have it, you can see it on the daily. I'll talk about it in just a second. Inside candle. If the inside bar breaks out, right, which doesn't look likely, the structure here, let's go through it as we typically would. I'm getting a little sidetracked with that volume study. The inverted hammer here is suggestive of some sellers in the upper wick. There's no doubt about that, right? So it would seem with a little bit of sell side pressure, some thin structure retracement might be on the table for the weekly chart. But what's the question to ask and answer here? Is it a pullback from a lower high or is it a pullback from a higher high? Of course, this is a higher high, and therefore we would just be seeking some kind of higher low. So let's throw a fib on this. And let's just check from this pullback low up to this high where the 38.2 is. It's literally at the low of that breakdown from now 2 weeks ago. If you were to break the inside bar low and support the same level, it would just be bull flag consolidation on the weekly. Ideally, though, I'd like to see a quick rally like right out of the gates early on in the week that suggests some kind of price acceptance over these prior highs. That would be the most bullish outcome here for small caps. It would continue to speak to the broadening nature of the market rally. If we jump in with the anchored VWAPs on the weekly time scale, those are the S&P ones. We're above all those. It's not like all they are different date anchors, but let's go over to the IWM, and it just cleans it up a little bit. Still over the entirety of the stack, no problems with that. And we can jump into our volume profile as well. And as you may or may not recall, we are right at the high volume node, right there. It was the same close, but you can look at these two bars. They're about roughly the same close on the weekly time scale. Same as last week, right at the high volume close, which ideally would be above for next week. Bulls, rejoice in that situation, and bulls still look for the higher low here, but it gets a little bit sloppier. Let's get a bit more granular, though, with these small caps on the daily time scale. We'll firstly evaluate the expected move. You can see it's here. Upper bound is at 255.06. I'm getting used to saying 600s with this NASDAQ and S&P. 255.06 upper bound, equal high to last week. And the lower bound is at 247.78, an equal low on par with the Wednesday session of now 2 weeks ago. So I'd be a little bit more neutral on the expected move here. Now, we know there's been a much more substantial rally out of small caps through the low of this 1120 bar, straight into these brand new record highs, and now pulling back slightly. So on the daily chart, I really don't see this as anything more than just bull flag forming. And once again, on the weekly chart, it would be ideal if we could get more acceptance up here in the upper portion of the flag. But as you can see, it's not unreasonable that holding this low is also structurally relevant. Previous highs all through this, previous lows acted as resistance here, acting supportive there. As long as that's intact, so basically the distance of the expected move this week, as long as that's intact, I would still remain bullish on small caps. Thinking through, once again, the lens of bull flag here, nice strong rally, price needs to digest, set up a new base basically at the new highs, and then eventually over time we brigade bolt out of it for some potential breakout. It would be ideal if we had some sort of catalyst to go with it. Is that potentially going to be the Fed? Is it going to be a really great labor report? I would say it's less about labor and more about really great inflation report that comes in much colder than the expectation, indicating that inflation subsiding and the tariff one-time price shock is done, right? That would be really optimistic for small caps. But for now, just kind of thinking through the lens of bullish digestion after the major rally through Thanksgiving. You didn't really get much of that advance this week. It's the only weekly bar that actually closed red in terms of the three indices, of course, and that was that. In terms of the Friday session, though, I do like the daily structure as well as the two lows here off the 20 SMA, right? You've really just been surfing the 20 SMA here on small caps. And what I think is most notable about this, let's go down to the hourly chart to take a look. On that session, particularly Friday, you opened and immediately had an opening drive, taking out the two equal lows from what would have been Tuesday and Wednesday here. So if sellers are going to really flex the muscle, they should not allow a daily intraday consolidation on Monday or earlier this upcoming week to happen over 251.35. I think you have an easy arbiter of price this week with that daily 20 and the 2-day low being right at the same spot. If you're over 251.35, I think it's fairly straightforward that the market's trying to remain a little bit more bullish. I would think through the lens of look below and fail, targeting some sort of reversal that looks like this, eventually making it up towards the all-time high. If we start spending more time in just bear flag consolidation, again, not the end of the world, but you're probably not thinking about a momentum-driven breakout where everything's firing on all cylinders for the S&P 500, right? If you're starting to stay underneath 251.35 and even dropping that Friday low for a hourly bear flag breakdown to get to the bottom end of the daily bull flag range, right? Which I would really start thinking of as here at 248.25. So that's what I see from that point of view. Let's drop it on down to the anchored VWAPs intraday. There we go. Right in the cluster. So I think it's fairly straightforward, right? Please call me out if you don't think so, but that would clearly unlock upside over the key level, over the anchored VWAP. And this is probably, less of a short and more of a long off of anchored VWAP support down here at 248.25, the bottom end of the daily bull flag range, right? So that's what we're seeing over in small caps. I realized I would tell you what this is all about. Just dollar volume, the average 20-day, what today's shares number are, and what the percentage of the 20-day average has traded today. Just to give you a sense of from a relative volume perspective, is it elevated? Is it not elevated? Is it really light? You can clearly see, and it's not much of a shock, that all of these Friday bars will likely read something less than 50%, right? Just not a lot of volume in there. Okay, so hourly's done. Let's go on over to our Russell side of the market internals and see what we get at the index level here. Friday, what we care about is how was the bounce off the low of day. Muted, and I would say muted here off the low of day. So nothing to really write home about. Once again, more of an equilibrium on the small caps as we just digest this. And quite literally, if you use this as a pivot high and this as a pivot low, you're pretty much trading smack in the middle, right? Not quite the dead center. You opened at the dead center, but you close near the center of that range headed into the close of Friday. So equilibrium until proven otherwise. I would continue to use the guardrails here and the guardrails here in the major sense, and in the minor sense, use what we just talked about on the hourly off of 251.35 and 252.75. Let's get on over to the Russell side of the market profile and see what we can glean from this perspective over here. Notice that the Monday gap up did bring value higher. There is a very poor high there, EFG period, flat across the top. So that lacks material excess that would seemingly need some sort of repair. We will carry that forward in the narrative, which is technically bullish for the small caps. You can also see a lack of material excess happening here on the what would have been Wednesday session, getting my days in the right order with the holiday. And we did not take it out here in the Friday high. Value is lower on Friday inside of that bear flag consolidation, but this is a clearly shaped B-shaped profile, which just means long liquidation off the high, not necessarily new money sellers, right? New money sellers on a trend day is just long drawn out bars that look like that, right? And you just don't have that here. So all set with market profile. Let's jump on into our sector watch now. Let's see what's going on from this perspective and what's going on from a rotation point of view. So who was leading, who was losing, and where was the weight? Leading is real estate last week, up 1.68%, followed by financials and then materials. The only thing that strikes me as being noteworthy here is financials. They are the second heaviest weight sector, and they are also risk on. The bottom end of the barrel, we have the XLY, so discretionary. That's pretty risk on, and it's also decently weighted in the S&P 500. We also have energy and consumer staples. Energy, consumer staples are both lightweight. Staples in particular are D for defensive. Not the end of the world there. XLK was also a laggard, underperforming the index by about 60 basis points. Roughly. Actually, spot on. Right on. 93 and 33. Right on the money. So posture strikes me as being bullish. Where it's not like we are just totally getting broken apart here and the tech sector is lagging big time. The market's trying to break out. It's a small lag. Right, it's definitely a small lag. It's there. Semiconductors did outperform on the week. You could see up, 2 basis points, but nonetheless, it is still outperforming. We also have healthcare, which has been a pretty good and interesting theme over the last little bit. If we had utilities at the top of the list, followed by consumer staples, then I'd be saying, all right, something's wrong here as we were breaking out through the week, but we just don't have that. We do have financials, notably breaking out to a new record high, and that looks pretty darn good, following in the footsteps of the big banks primarily, JP Morgan, Citibank, Wells Fargo, Goldman Sachs, Morgan Stanley. The whole cohort has really gone for a nice ride there. If we look at real estate, big gap down only to rally back. So is it really the leader of the week? Intra-week, the tradable range of the week, sure, but generally speaking, it made negative progress, right? You technically got a little bit of a bounce back, but we're still underneath the 7-month balance range. If we take a look at the financial sector, once again, this chart looks absolutely stunning. Breaking out of this bull flag, breaking to the upside here, brand new record highs, inside candle consolidation on the Friday session. It looks really good. So I would say weekly pullbacks into this level, any sort of new equilibrium that forms up here is bullish, continuation in the upward direction. If you get a daily bull flag that forms like this, that's also bullish, consolidation, then Brigade bolt into blue sky territories. Nothing wrong with this chart. We know that we're headed into early January, which about the midpoint of January, we start to get earnings season to kick off, which has always started with the banks. We'll hear from JP Morgan first on, I believe it's Tuesday morning of the 13th, perhaps, of January. Don't mark my words. Yeah, we'll check later on in the earnings calendar. How about that? In terms of the materials sector, really strong rally to the top end of the range. We know that materials have been doing well. I mean, mainly commodities are on a tear right now, and this is following suit. If we look at healthcare, I'd say just mostly range compression. It looks similar to the small caps chart, does it not? Maybe even a little bit better with this equal high shelf poised for possibly a breakout, right? You're coming in from low, higher low. I get it. This is still possibly a lower high, but if you just consolidate and compress here over the daily 20, the tailwind is up. I would think this maybe lifts the healthcare sector a little bit headed into this next upcoming week here. And there's been pretty thematic trades there happening in BMY, Bristol-Myers Squibb. ISRG looks really good. We'll take a look at these charts later on in today's episode. If we look at the XLU, nice little bounce back over here. Once again, like the XLRE, they kind of made negative progress, though, overall, it's not like you closed a new high up here. Let's take a peek over at communications. Chart looks really great with the inside candle on Friday. I'll be watching this very, very closely, and a lot of the Mag 7 stocks actually have this exact setup, if not better. I think there's a lot to talk about over there. So as of right now, communications, really healthy chart. I would be looking for something like this out of the multi-week balance range. Can we get that lift into the all-time highs? That would just be bullish for the S&P 500 as a whole. If we look at the semiconductors chart, this one's not quite as good. I think the comms chart looks way better. This is a loose bar, just kind of a doji up in the middle of nowhere. To me, it looks like either continuation higher or pullbacks into the moving averages, seek some sort of arbitrary higher low. As long as it's a higher low relative to this, I would still remain constructive on the semiconductors and ultimately seek new highs at some point in the future. I probably don't want to take it on just a V shape right into this high. Typically 100% retracement does see a higher low pullback first and then go. And you could make the argument, okay, well, here's your 100% retracement. Here's your higher low. Let's see if we go. Right, I could see that argument, but to really get involved, I need a tighter daily setup here underneath the all-time high level. Let's jump into the industrials chart. Looks pretty good to me. Breaking back out and consolidating over that previous shelf at 156. Consolidation here is constructive for a flag, and let's see if we can get continuation into blue sky territories. Here's the long bond. Just slightly lower. As we know, rates keep creeping slightly higher even post-Fed rate cut. I think that the market's primarily waiting for the 6th, the week of January 6th. That's the first full trading week of January to learn more about the labor situation and make some assessments as to what should happen with the rates. Let's jump on over to tech, see what's going on over here. Looks very similar to the QQQ, does it not? Again, maybe even the semiconductors, rinse and repeat the same analysis. Kind of a loose daily bar here. It's not really tucked in underneath these prior highs. You could say you're starting a breakout, ideally consolidation and holds go on to fill this gap above. If we pull back in, consolidation here still keeps me bullish. I generally want to see a hold over 143.75. If you start failing that level into here, harder to trade, in my opinion. I'd be less interested. Why? It's this high from back here. It's the 1120 bearish engulfer high. I really don't want to see prices back underneath that. You overshot it once. Let's not overshoot it twice. Let's jump on over to the staples. No dice on the inverted head and shoulders. The retail theme has sort of fizzled out just a little bit. I will say that this looks, unchanged maybe on the week, 33 basis points. So hard to really say next move other than just supportive off the lows. Is it really a big deal for the broad market, though, overall? Like, do I look at this chart and say, oh, my God, we can't, S&P, it's hell in a handbasket? No, absolutely not, right? This is a lighter weight sector. It's also D for defensive, so not overly, concerned about what's going on there. Energy failed breakout. This is somewhat interesting to me, and primarily because of what it represents based on crude, right? If we jump over to crude, and I do want to correct it is already checked off. Beautiful. It got rejected big time at the trend line into the end of last week. I was expecting a little bit of a break here. It's not often that crude just gets beat up this aggressively with no catalyst and doesn't get a bounce back. So I'm still looking for a potential opportunity in crude. It tends to be a pretty tricky thing to trade in terms of how it correlates or translates, I should say, over to things like XOM. Right? Look at this. Maybe when the trend line breaks, there's something to do here in XOM. FANG, as we know, pulled back into this range. It's pretty fickle. So it's staying a little clear of that. Energy is not one of the big sectors that I love trading, but if CL can break that trend line, I'd say XOM is your primary contender. And as we know, the reason behind that is just because it's a weekly base, right? We'll just revisit this thesis because why not? Here's your weekly bull flag. If XLE/CL can break that, maybe you're off to the races here. Again, a little fickle trading that energy stuff, not my favorite. Let's go back through and finish up with the XLY, then we'll jump into some more supporting evidence. So basically, through the supporting evidence that we've seen thus far today, XLC looks fantastic. XLY, as we're looking at right now, also looks pretty darn good. The XLK, I'd like it to clarify. I'd like it to do something a little bit more actionable on the underlying chart, but there's nothing that's an alarm bell. And, how could I omit the XLF? All the sectors generally look good here for the S&P 500. And if you're just considering, like, why is that NASDAQ underperforming? Why is it underperforming the spiders? Well, look no further than the XLF, right? There's no financial companies in the NASDAQ 100. So that's the logic as to why. XLY looks great here. I think Amazon, Tesla both continue to look decent in terms of their daily bars. So consolidation here. Bullish over 120, 125. Can we get the lift up and over 123.65 becomes the next big question. If we can, great, let's rock and roll. Blue sky territory is bullish for the S&P 500. Let's get into some ratio versions of these charts and just take a peek over here. If you're not familiar with the ratio charts, check out the video tutorial in the top right-hand corner. Question: do you guys even click these things? Do I point to them for no reason? You can see, even if you're on a TV or if you're on mobile and you're like, I can't click on the thing, you could just go in the description of the video and find the link there. But should I even bother with that anymore? I have to edit it in every single time. So if you're like, no, then forget about it. Into 2026, we'll leave that in 25 and we'll just move forward. 25 has been great. 24 was great. The whole entire Trade Brigade experience has been great. But what's the next thing? Right? And it's not maybe just a small edit like not pointing to this, but what do you guys want to see more of? Right? I probably should have started with that question, but anyways, here we are. XLK. Not really a risk off signal. It's more so flat than anything else. I'd go neutral there. This looks great on financials. This looks decent on communications. Looks pretty good for a higher low opportunity on discretionary. The top four are the risk on boxes. That looks pretty darn good to me. What's going on with the bottom two in terms of risk off? Not firing and not firing, no problemo. Let's jump on over to the risk on off A set. Okay, I'd argue here, okay, with a little bit more of a check mark going on there. This is This is looking all right. No dice over here and no dice over here. So a little bit more of a mixed bag, neutralizing the stance a little bit. Once again, no red flags that are screaming from the rooftop saying, oh my goodness, don't trust this market. Not seeing that. If you look at the gold ratio over here, yeah, we know that metals have been on a tear. I think gold and honestly silver is starting to trade a little bit more like a speculative asset rather than a safe haven asset. I'm not going to pretend to be a silver expert, but what I am an expert in is technical analysis and charts. We'll talk about silver in just a second. Before we get there, Bitcoin still in a bear flag configuration on the weekly, and we do not have a cross in the Sailor Shift tool, so I'm still hanging tight on Bitcoin. As mentioned in the intro, Tom Lee, I think you're going to be off on the 100K call into the end of the year. I do think Ethereum maybe poses a more interesting use case into 2026. Financials, banks, institutions likely to start using a bit more of digitized blockchainized, is that even a word? Technology as we head into the future here. You're already starting to see it in some of the banks, even if they're not talking about it aggressively. It is happening in the background as confirmed by a couple of sources. So Ethereum, more programmable, more malleable in terms of use case. Bitcoin, kind of the store of value, the old man of crypto. In terms of the TLT chart, no signs of risk off happening here, but I do want to drift on over to SLV for silver. Now, again, I'm not here to sell you on the idea that I'm an expert. I understand what's going on with the China supply. I understand, the whole ins and outs of what's going on with the restrictions and what the use case. I'm not here to do that. All I'm here to do is to say, if you are a buyer at the tippity top of the move right here, right now, if you are not long from this breakout over here, then you have the wrong idea. This is a euphoric top. From a technical perspective, go back and study all of the tops ever formed in the market that happened on a parabolic run. What you see is an increase in volume, usually about 200% or more than the average of the more recent volume. Hence, the use of the tag here, 278% of the average 20-day volume on silver after having already added some of these elevated sessions in here. So you mean to tell me you want to buy silver here versus on the breakout of this over here? I don't know about you, but this starts to look more like a parabolic short opportunity rather than a parabolic long. Let me get on board at the tippity top of the move. Just like what we saw in gold, right? Let's go back to gold. Let's remember this. This is the equivalent of being like here on gold, right? Here's your 200% plus day on volume, this red day as well. And then what do you get? You get more of a consolidation, more of a cool off. Now, I'm not saying that silver can't do something that looks like this. Base out for a couple of weeks and then attempt another move higher. Silver could follow the same exact blueprint. But with everybody talking about silver online right now, you got to ask yourself, like, do I really want to be the suckers long at 71? Again, there's no problem with looking at this chart and saying, yes, it's a fantastic bullish trend. It is absolutely a long. right? But is it along here? Becomes the question. Where do you manage your risk from? Where do you place your stop loss? Do you buy it here with a stop here? I think you're asking to get stopped out. Even if this consolidates into a flag and you're not technically wrong about direction, in terms of risk management, where can I place my stop there? I can't. So unless you're already long silver, this is more of like, let's watch for a parabolic top rather than a potential new money long. And what I want to do is just add the Bollinger, right? Bollinger Band is a classic helpful tool in terms of trying to spot that. What do you see? I mean, you've closed up and through the upper Bollinger Band at this point by, I don't know how many ATRs through we are, but really, I mean, look at this. You're sort of trading double the ATR on an already expansive move, elevated volume. My point isn't to say go out there and short silver with both hands. You do whatever you want to do on Monday, but my point is just to maybe stir the question and get you thinking about, is now the time to buy silver after it's already been up so substantially? I mean, you just exit liquidity at that point, right? What did you see in the gold headlines when it made that parabolic top? Everybody was lining up outside of stores to buy physical gold. That is the exit strategy, right? Anyways, that's your silver conversation for today's session. And maybe, again, Tom Lee, if he forecasts silver going to the moon instead of Bitcoin, would have been a little bit more correct into the year end. Let's jump back on over to our ratios here and finish up with our dollar and rates. Again, I think that the market's waiting for, and it's always a waiting game with the fundamentals. Let me be the first one to admit that, right? It's a waiting game with these fundamentals until the 6th, the week of the 6th from January on the labor situation. JOLTS, I believe, comes out on the 7th, maybe the 8th. It's the Wednesday. I do know that. So whatever the Monday is, 5th, 6th, we'll take a look at the economic calendar in just a second. And again, it'll impact what happens here with rates as well. Now, what do we want to watch for? Like, it's one thing to just say, oh, let's just wait and see. But what do we actually want to watch for? If the JOLTS number starts to suggest that there is a restriction of workers or a shortage, rather, of jobs, right? And people are like, if the employment, how do I want to frame this? Basically, my thesis on the fundamental side of the market is that inflation will likely continue to move in the downward direction. We're seeing it with shelter inflation if you observe something like Zillow. So taking the base case that inflation will move lower based on shelter and sort of input costs coming down now that tariffs have been sort of worked through the system, if you will, my idea is that the only thing that would possibly reignite inflation is a wage price spiral. How do you get a wage price spiral? It's like very few jobs, plentiful jobs, and enough people out there who are looking for them, right? So what you want to watch is the JOLTS number. You want to watch the employment population ratio, right? How many people in the populace versus the employment rate. So those are the things you want to watch. If you get the conditions such that there is a low amount of, how am I going to frame this? My goodness, thinking about this in real time. You want to see a high amount of jobs. Jobs are plentiful, right? And therefore, what do companies have to do to become competitive? They have to raise their wages. How do you get that situation as well? Well, you're not going to have to see a huge pool of labor participants, right? If workers are a dime a dozen, then that's where the saying comes from. You're not going to get a wage price spiral. So you need to see the number of job openings up, and you also need to see the number of people willing to be employed, aka employment population ratio, moving in the downward direction. Not very many people to be employed, your supply of labor, right? So anyways, thinking through that, that's what I think moves the dollar and interest rates as we walk forward. And the market's not stupid. It will likely be watching those things at a much more rapid and precise pace than I will be. But that's generally how I'm going to be thinking through those points. Inverted ZT for our 2-year, Fed watch. Unchanged. I would still bet we're somewhere around the odds of like 80% for a pause in the next meeting. Let's take a look on over here. Yeah, 84. I don't know if I've refreshed this since. Let's give it a little refresh. Probabilities, and 82. So it moved ever so slightly. 82.3% odds of a pause in the next meeting for the 28th. That'll be here before you know it. The calendar on the economic front, side and front at the same time as SUNT, apparently. We will be getting the FOMC meeting minutes, jobless claims, and that's really it. I don't think that this is going to be an interesting week from an economic data perspective. As mentioned, it's all about this week, the week of the 5th. There we go. Not the week of the 6th, the week of the 5th. ISM manufacturing PMI worth talking about. And, I don't want to waste your time going through all the ins and outs of these right now, but you can see all of the labor data that we get here on the week of the 5th and the full Monty labor report happening down here. That's the big spot to be watching. It's a week, 2 weeks away. So no need to get into the nitty-gritty, even though we just kind of did. Let's refresh the earnings calendar apparently as well. Everything refreshing in the background as I stumbled through that labor situation. There's nothing going on here. Nothing going on. The market is closed on the 1st, as we know, and then there is JP Morgan on the 13th. Let's pay very close attention to that as they kick off the earnings cycle headed into the new year. For now, again, fairly light on the economic and earnings calendar. Let's get back on over to the platform here and let's finish up on a strong note. No more stumbling over words or theses. What's going on with the bond market here? It is sniffing out the inflation problem, right? So if the labor side of the market is going to show a wage price spiral, if this should continue in the upward direction, the market is worried. If this can start to stabilize or even roll over in accordance with these stabilizing and then get back under or near its daily 50 instead of so more, firmly above, that would suggest that the market's less concerned about an inflation spike. Let's jump on into, and if you read a lot of these 2026 outlooks, if you're a nerd like me and do that, then you'll see that a lot of banks, and sometimes the consensus view is the exact opposite of what happens, but a lot of the big banks are forecasting that inflation is really going to struggle to get down to the 2% Fed target on the nose, and it will be much more sticky and persistent than most thought into the end of 25. If we look at the credit spreads as a proxy for volatility, VIX is down through the floor, but your actual credit spreads are not really subsiding all that meaningfully. So just keep that in the back pocket as well. Don't be shocked if the VIX is a little bit quiet because of the holidays. Let's get into junk bonds in isolation. We are divergent based on a lower high here on the gap down from the dividend payout. In my back study of the HYG, regardless of dividend payout or not, it has typically tended to lead the S&P, even if you turn off that adjustment for dividends. So with that, if we jump into the SPX, you could see we're clearly higher versus lower here on a lower high in the HYG. We'll take that day by day into the coming weeks worth of trade. Let's get on over to breadth. Breadth ratios over here look pretty darn good in terms of 50 and 200 SMA. Components trading above. New highs versus lows still positive. And if we take a peek over at the RSP, we saw the SPXT looks about the same, right? All set over here on the equal weight S&P 500, the equal weight NASDAQ we looked at already. So let's move into volatility. Getting absolutely crushed on the lift through the holiday trading session. Makes sense. No coal for the market on Christmas. Let's jump into the VVIX. Same thing, getting crushed down here. We haven't seen it this low ever since the tariffs and the explosion in volatility back there. So I'm not going to sit here and say that the market needs to see a rebound in volatility because it's just too low, but you could see a repricing of volatility and maybe withstand a little bit more give and take on the S&P instead of just one-sided unidirectional trade in the upward direction. If we take a look at the vol futures, really deep contango on the current versus back month. All the other timeframes also in contango looks good here. One-day VIX, lowest lows we've seen in a very, very long time on that. I do want to check in on the skew. Skew is, I'd say, unchanged over the last couple of weeks in here. And then maybe also, we haven't looked at this in a very long time, but the P call for the put call ratio, anything? No, we looked at it here when it was up over 1. That typically starts to mark a little bit of a bottom. And as we know, that was in here as we were dealing with the daily pullback. So you're just kind of in normal territory for the put call ratio. With that, let's just reset this so I'm ready to rock for the Monday session. Let's go here, and let's take a look through the core list of companies, starting with none other than NVIDIA. NVIDIA, I've got to give it to it. Looks good on a double bottom breakout over the neckline, over the 50 SMA. A little bit of give back on the Friday session, but honestly, that's a good thing. I would love to see the pullback into the 50 SMA on NVIDIA into the early stages of this week to set up the higher low over 184.75, 185.85, 50 SMA, set the higher low, and then seek some kind of continuation in the upward direction. Really strong break on what would have been the Tuesday session, and then a nice inside candle on Wednesday. Didn't really offer a decent setup on the Friday sort of slow volume day there, but nonetheless, it is higher, and I do think it's constructive on pullbacks, as we stated, over 184.75. Let's go on down to the hourly chart. You can see it here. There's your little inside bar. Again, hard to participate. Look at the pullback. Look at the pullback into the end of day. I would prefer to see this, honestly. This in here is where I want to get involved, right on these potential setups, right in there on the pullback long, 184.75. So that's NVIDIA. Let's take a look over at Apple. Not really interested in this. Surfing the daily 50, but pinched between the 20. I'd like to see something that gets here, perhaps, that starts to look decent, and then here looks really good over this 280.25. A lot of work to be done. The Friday bar does not look all that compelling with the large upper wick paired with the Wednesday upper wick as well. So not really in love with Apple's chart, but what I am in love with is this Microsoft bull flag. So let's take a look here. Look at the inside bars. Look at the recovery over the daily 20, now surfing, using it as lows lows in that general zone. If you could take out these highs, at least thinking about the top end of this range here after a look below and fail on the daily 200 from this most recent pullback. Beyond that, you really start to set up a more constructive daily double bottom if this ends up being the case, that you can clear out over that 493 and also break the daily 50 SMA. If this goes sideways for another day or two and this continues to come down a little bit, right, wouldn't that be something if you start to get the break here, okay, compression again, and then a break through the daily 50 higher low above, you recover that moving average, and now you're, I don't want to say off to the races, but much more constructive for a possible upside move, with reorientation of the moving averages seeming more likely than not over the next couple of sessions, weeks perhaps, if that's going to play out in the bull manner. So that's the optimistic take. Very optimistic there. Look at the inside candle from Friday. If you take a look on the hourly chart, it's really nothing more than a bull flag here. And once again, first step is just where's this breakout over 487.75. Consolidation here, Brigade bolts above. That's constructive. Next phase, think of it like building blocks, as we typically say, stair steps, if you will. Next block, right, over the daily 50. Things get much, much better in that situation there. Where does this fall apart? Well, if you do this, you're just back at the daily 200. You've tested it once, twice. Third time might be the charm for a little bit more of a devastating move in the downward direction. I'm not here to forecast that, but that is the next look for Microsoft. What happens with this little range? I'm thinking of it through the lens of bull flag, noting what happened here off the 200 and the pretty resilient hold. Let's jump on over to Amazon. Amazon also looks great with these little inside candles into the end of last week. Look at the inside bar there on Friday. Even if it's not perfectly inside, let's not split hairs here. Nice consolidation, tightening up, possibility over this 233 into this prior pivot high at 238.75, which on the daily chart we know is the top end of this balance range here. So can we get higher lows continuously coming into that high? And will we get at some point a constructive break, right? What's the thesis for Amazon? I mean, AI, it's data center, AWS, it's also robotics. So I think all of these themes, it's not like they just end as the calendar flips to a new year. They're still definitely in play. And I think Amazon's a big beneficiary of that still. Over the 50 SMA on this one, even better than the Microsoft chart. Let's move on over to Google. Another really great looking chart, a new leader of the AI frontier with the whole TPU conversation and what's going on with their ASICs, basically. I like this inside tightening up at the daily 20, excuse me. I also like the recovery effort over this, right? Pretty aggressive overshoot, but just as aggressive to reclaim. If this can now stay in the box or break out of the box, thinking about going back towards the highs on Google, that's holds over 310.50. I like the chart setup here. Here it is on the hourly. Once again, think through the lens of bull flag until proven otherwise. Can we get something that looks like that? Really nice tight inside day on Friday. Let's jump on over to Broadcom. It is technically an inside bar, but I don't like this as much. Do you know why? I think you should. Here's the gap and go to the downside. Aggressive. This is just a bear flag. It's not like we've tested the daily 200. We are just at the bottom end of a balance range. In my view, I don't really like this one as much. If you're a long-term shareholder of Broadcom, then like so be it and whatnot. That's all set. But in terms of tradable outcomes, I think Google, Amazon, and Microsoft, for that point, all look far better than this Broadcom. Could you still get a break over the two-day high for a thin structure retracement? Yes, absolutely. Here it is on the hourly chart. You could break those two-day highs and start to get some lift into the moving average. I think it's just going to be more of a headache than those other three charts that we've looked at thus far. Metaverse, another one that's tightening up, but what I don't like about this is that the moving averages are all squirrely. You're pinned underneath the daily 200, the 50, and the 20 are trying to act supportive. Doesn't know if it wants to break the top end, the bottom end. It doesn't know what it wants to do. I've taken this stance on Meta for the past couple of weeks. If this is going to be a cup and handle, that is fine. I need to be over the handle or under the handle. So that is going to require a recapture and a reclaim of the daily 200 SMA over 681.15, or all this is noise, a breakdown here for a thin structure retracement to the cup low under 637.50 into 604. Until either of those two things happen, I don't love this chart inside of this range, and I think it's proven that it's not going to be lucrative to trade in there. Noise. I don't know what I'm doing, right? That's what that chart says. Let's jump on over to Tesla. Tesla still looks great. I'll remind you on the weekly time scale, let's not lose sight, not the 4 hour, the weekly. Let's not lose sight of the weekly thesis here. This is a cup and handle. We are breaking out of it. We're consolidating, or at least attempting to consolidate over the top end of the handle. As long as this stays over 470.75, things look pretty darn good. Let's go on down. Oops, we want to do this. We want to do this. Daily chart. There we go. What do we see? Compression, bull flag. This has been... It continues to teach the lesson over and over and over and over again. Tesla will have that day someday with the 7% upside, but you need a lot of things working in its favor. And I don't know that it's ready to do that again. So what's the lesson it's teaching? Makes more sense, and it's been more lucrative to be a swing trader of Tesla rather than an intraday trader. If you try to buy these breaks over previous day high, buy break over previous day high, if you buy the all-time high break on the bull flag, attempt into blue skies, None of those have been rewarding through this entire thing, even on some of the days where the broad market has been higher as well. So Tesla requires being, or at least recently it's suggested, that your best opportunities are going to come from swing longs. So what does that mean? I'm open-minded to if this pullback can persist over the daily 20, is there some kind of gap fill reversal? Is there an undercut and rally? We call look below and fail around these parts, but some people call the undercut and rally, whatever. If we can get that off the 470.75, I would like to position potentially long there, right, to at least range trade this to the top, and then breakouts are gravy on top. This starts getting into a much more clean trend, in my opinion, if you can clear out the 500 strike. It is just littered with calls and open interest at that level. Let's take a peek over at JP Morgan, and because it's in a daily balance, that little range there's nothing to say on the hourly. Here it is, JP Morgan breaking out of a multi-month consolidation. This is constructive. If you look like this, it looks good. If you look like this, it looks good as well. I generally lean long here on financials, on banks. JP Morgan is just playing catch up. We know this. Citibank broke out long ago and continued higher. Wells Fargo did the same thing. Long ago broke out and is continuing higher now. JP Morgan on an equivalent basis is like here, right? So looking for JPM to continue along in this narrative, helping financials higher, which once again is going to prevent any major bear thesis on the S&P 500. If you want to be short something, be short tech, but don't be short the S&P 500 index if financials are ripping into blue sky territories with really constructive charts out of multi-month bases. Let's take a peek over at Palantir. I think this is a great pullback. I would like to see, I would like and want. Don't know where my brain was going with that one, but I want to see what happens here at 187.25. I like the aggression on Friday. It was one of the only names that had an aggressive day. I mean, this is down 3.25%. Everything else mostly like 20, 30 basis points, give or take. Tesla had a down day, but still in range, right? This actually broke from range. Had an aggressive down day. What happens here is the big watch. Can Palantir set up the pullback for a higher low and then go on to close more of the gap above? That's the big question. 187.25 is the big spot to watch as of right now. There's no indication of a long looking imminent, but if we start to do this and then we come back above and build out a right shoulder, what did I just draw? Left head, right shoulder, neckline. Let's get long. Let's start targeting the gap close to the upside. This was looking pretty good out of this multi-day flag in here. Right now, it's just coming in for a retest at the top of the range. Needs to hold 187.25. If it fails, back into no man's land, back into just not touching it until you can resolve this box once again. Is it frustrating? Yes, but that's just the nature of the chart right now. AMD, what's going on over here? Another one that's you got tight inside bars, but there's just nothing to do with it. What am I going to do here at the daily 20? Breakaway, and also in the middle of a range. So AMD strikes me as one of these charts to avoid over the next coming week. Could you get a nice move to the upside? Sure. There's always the possibility of a nice intraday move that goes on for, 2-3% or whatever, and you can come back and you can say, oh, look, it was such an easy long. Be my guest. You take stabs at the midpoint of a range like this over the lifetime of a career in trading, 50-50, maybe your break even, maybe even slightly negative expected value. So for now, really steering clear of this AMD. Maybe it's this as a scalp. Just what are we doing here? It's not a clean chart. It's in the middle of nowhere. If you do this, maybe there's a thin structure retracement to the downside. I'm just watching it. I'm watching it for now on AMD. I'd like to see it if it's going to be a short into this range down below. If it's going to be a long, got to get over the daily 50, got to reclaim this neckline area from right around in here. Let's move along and finish up with Robinhood. Speaking of necklines, this also doesn't know what it wants to do. Here is the double top neckline right at this box, 1 and 2. No idea, right? Just drifting around, doing nothing, a little bit higher, failing, a little bit higher, failing, consolidating underneath. Doesn't really look like it wants to break down all the way. Need more information. So what does that mean? Be my guest if you want to get chopped up inside of this range. But for me, you got to be here and you got to be here. Unless it's doing one of those two things, under 114 or over 124.75, nothing to really do. If you're like, no, I don't want to short it at 114. I want to long it here for range low to range high, be my guest, right? You could also say this. You could say range low is a long, and you could say that range high is a short, and you play ping pong in between until something actually breaks. Be my guest. As a more momentum-driven trader myself, I would prefer to get up and over 124.75 on the classic Brigade Bolt, something that looks like this, or down and out under 114 for the Brigade Bolt that looks like that. These two things are the watch on Robinhood, and that is the core list of companies. Next up, it might be inducted into the core list of companies because it's just been that great of a trader recently, but MU, look at this thing, earnings, gap, and instead of crap, it did for one day, but gap and go, almost off the screen there. It looks good. I'd say the potential for a hold of this 277.50, who let that slide, 50 spot is what I'm looking for. If you look on the hourly chart, right, you could either get this gentle pullback through the thin structure and start to stage longs off of this. If that does not hold, then it's just got to be here. I wouldn't really do much for an arbitrary high or low in this. I would say show me the retest of the previous all-time high level, 260.55, and that's where I'm getting more interested in a daily high or low. Something that looks like that, right? So MU, fantastic first trade idea. That's 1 of 4. Next up, believe it or not, it's sort of like taboo to even talk about these days, but Oracle, we got to do it. Got to do it. A little bit of a hourly cup and handle happening down here. The only reason this is interesting is because you have moving average confluence. Now, before we just start throwing a bunch of money at Oracle, under the daily 200, under the 50 with an aggressive downward slope, even under the daily 20 as of Friday's close. So is this just a blind long early on? No, you do not have the trend in your favor. You're actively fighting an aggressive downtrend. But if this is going to be a bottom, and remember, into the end of last week, we did start getting some upgrades on Oracle with multiple firms saying that the damage is getting too severe. We're starting to think about upgrading the targets on Oracle. So not a guarantee that it goes higher. Remember, firms can use you as exit liquidity if they just start thinking about that. And again, I hate playing the us versus them game, but it's classic. You see upgrades at literal all-time highs and the stock starts tanking. Well, what do you think's going on? Selling into that upgrade. Anyways, without being jaded, if this is going to be a cup and handle, then you need intraday to see a Brigade bolt over 202, start closing this gap above, and I would like to see it with a catalyst. If you do not see a catalyst on Oracle early on for this potential break, it becomes instantly less appealing. If there's a catalyst, a lot of news coverage, maybe something new about funding, anything positive for Oracle that starts to get the break on high volume up and through that 202, again, with catalyst, that gets interesting. If there's no catalyst, if there's no high volume, if this just starts drifting into it, it could go on to close the gap all the way. That's kind of a poor drawing because it wouldn't really be momentum driven if there's no volume. It could close the gap all the way, but I'm probably not participating unless there's a catalyst, right? So that's Oracle. Next up, we have BABA. BABA was brought to us by AB over in the community, and this just looks great. Right, looks pretty good here. Previous high, now acting as potential support over the daily 200 still. Needs moving average clearance here of the 20 and the 50, but you've got a little wedge here if this pops up and out of it. Maybe some kind of lift back up towards these highs. I don't know how to play it quite yet, but it is getting interesting and compelling as a weekly bull flag over a previous pivot. Alibaba pivot. Oh, I'm having too much fun here over the holidays. Alibaba done, right? Weekly bull flag there. Let's go to Rocket Lab. Of course, hot name recently, this whole space theme, data centers in space, solar panels in space. Who's going to send them? Rocket Lab. Maybe, right? This is in play. Can we come in for an aggressive high or low with confluence at the daily 20? That's what I'm watching for. Basically, some kind of interaction off the daily 20. We get fairly extended. Do we come back down to earth? No pun intended. Over the 64.15, 63, previous pivot high in here. Do we stage the next daily high or low? It would be pretty precise. The market would be like, that's an absolute gift if it happens this cleanly. But what do we know about gifts? Highs, 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 perfect low. So, it's not out of the cards for Rocket Lab. So we'll see if we get a little New Year's Eve gift into the end of next week, and hopefully not a lump of coal with some nasty overshoot. It gets sloppy, then it's back here, and it's here, and a catalyst, and all the whole 9 yards. That's what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. 2025 was a blast. We did a lot of cool things in 2025. What are you looking forward to in 2026? Be it in trading, be it in the market, be it from this channel. What new things can we do here that you're interested in? I got to always remember, this is basically my weekly review. I'm going to keep it in alignment with what I need to do to actually actively trade the market the upcoming week. But if we can bend things, if we can add new things to the analysis, take things away that you feel are distracting or a waste of time, open to feedback in the comments, right? So with that said, have yourself an awesome weekend. Have yourself a fantastic new year. And with that, we will catch you as always in the next one.